Welcome to the India Fintech Diaries, the only podcast focused exclusively on the Indian fintech market. I'm Elroy.
And I'm Hemant. In each episode, we dive into the latest trends, ideas, innovations, business models, and personalities that are shaping India's fintech landscape.
We also invite amazing guests who are innovators and industry players that are driving the change that is helping make financial services more modern, innovative, and inclusive in India. Come join us as we explore the changing landscape of fintech in India. Hi everyone, welcome to a new episode of India Fintech Diaries. I'm your co-host Elroy, and this is our show where we discuss the latest trends in Indian fintech and speak to some amazing guests from the industry.
And I'm your host, Hemant. Last week, we spoke to Mayank Kachwaha, co-founder and chief operating officer of India Lens. Our discussion gave us an interesting look into the role that platforms play in reducing cost of loan origination and making getting a loan seamless for customers. But what happens when it's time to repay the loan? Is there some way to make the process equally seamless and easy? Well, to answer that question, we have Aditya Singh, co-founder and chief commercial officer of CreditMate with us today. Welcome to India Fintech Diaries, Aditya.
Thank you, Elroy. Thank you, Hemant. Thank you for the invite to come on India Fintech Diaries and speak with you guys.
Great. Aditya, you have had an interesting journey. You started financial services with a fairly longish stint in the management consulting. Then finally, you launched the CreditMate. Can you tell us about your journey and the hypothesis behind founding CreditMate?
So as you rightly said, Hemant, most of my career has been in financial services, and even in management consulting, it's been in financial services with a lot of emphasis on payments. I was actually part of the consulting team that helped launch the RuPay payment and debit card scheme. Have run a few startups, also during my career. But I guess CreditMate has been the one that has had the most interesting journey so far. The thesis behind CreditMate was that we wanted to do something in the lending space, but we were fairly sure that we wanted to actually lend in assets that offered productivity benefits to the middle class and lower middle class. That is why when we started out, we zeroed in on two-wheelers. We'd actually seen how aggregation, brand building, and access to finance had grown the used four-wheeler space. And we want to do the same in two-wheelers. Again, with the growth in the gig economy, a two-wheeler is a great productivity asset. And that was our hypothesis to get into that. We did that for 2.5 years, did use two-wheeler financing. We were the first ones to do that in the country. New two-wheeler financing, we did a lot of dealer financing, loan against bikes. While we were doing the lending business, we realized that collections is also a major component in the loan life cycle, what we like to call the other side of the funnel. Of course, lending is the more glamorous side of the business, but an equally important part of the business is collections. You realize that being a new lender, we also very quickly realized that collections processes and infrastructure in the country were not really amenable to the new age digital lenders and digital NBFCs. Hence, we decided to pivot into providing services in the collection space, introducing technology in collections, and also providing a key infrastructure in the ecosystem, which the lending industry could sort of draw on. So while the lenders could concentrate on doing what they knew best, which was underwriting and building models for determining creditworthiness, we wanted to solve the problem that happens on the other side and use data and technology to solve that problem.
Now, I find that really interesting, Aditya, that you actually found the collections problem more interesting to solve than being a digital lender. And this is an eye-opener for me, especially given the fact that you see the number of fintechs that are aspiring to be digital lenders vastly outnumbers the fintechs that are actually tackling the collections problem. And I think that's also partly to do with how the collections industry works today. So maybe for the benefit of our listeners, you could probably give us an idea of the size of the collections problem that lenders are facing today and how fragmented the solutions to solve those problems are today.
So let me start with the first question. So to be honest, it's extremely difficult to quantify the exact size of the collections problem. If you look at most, if you look at RBI, any of the published data, most of the conversation revolves around NPAs, which are typically loans where the principal or the interest has not been paid for 90 days.
Yeah.
What a lot of people forget is that even someone who defaults and does not pay on day one and stays in the flows part of the collection cycle, which is 1 to 90 days, it is a cost to the lender to actually be able to collect. If I had to take a look at these numbers, and if you look at the RBI's financial stability report, which came out in July 2020, the gross NPA of all the scheduled commercial banks is expected to hit 12.5% in March 21 under a baseline scenario. expected to be even worse at 14.5% if things were worse. But thankfully, I think the economy is recovering a little better than expected in July 2020. If I had to give you a ballpark number, I'd say just the NPA problem, which is 90 plus, would be somewhere in the range of 200 to 250 billion dollars, and that's purely 90 plus. And if you include NBFCs and fintechs into it, while they are much smaller in sizes compared to the scheduled commercial banks, this would be a little bigger. Plus, anytime that NBFC or fintechs are given a loan, the underlying money is actually coming more often than not from a bank. So if the NBFCs start to default or borrowers start to default on NBFC loans, that has a ripple effect on banks' balance sheets also. If I had to sort of answer your second question on how the industry functions, it's extremely fragmented. While most lenders, especially fintech lenders and new age lenders, would want to be pan-India from a distribution perspective, you don't really have agencies that you could work with on a pan-India level. There would be large call centers who do some work in the collection space along with work in the sourcing space. But you would have to go find local regional agencies across the country to be able to manage vernacular and field visits. So these would be thousands of agencies spread across the country, and which is not possible for any lender, especially a new age lender, to be able to get on board. If you look at how the industry was earlier, most collection agencies have been centered around where banks have traditionally lent, and large banks have created huge internal teams, especially on telecalling side, to actually manage the collections problem. And more often than not, these were also centered around, where the bank's branches were. So any sort of field activities that had to be done was centered around branches, while most of the telecalling was internal. That's starting to change with at least later buckets being outsourced now to some call centers to manage. But extremely fragmented, limited technology in use, essentially almost a black box in terms of how the industry functions.
Aditya, anyways, collection has always been a very difficult problem to solve. And the way you just explained, if I'm a new age lender, I basically have two options, right? One is that either I set up my own network, which is going to be very, very costly, cumbersome, my scale space would be very, very slow. Or maybe I restrict myself geographically, but as you said, any new age lender would like to expand really, really fast. The third option is left to partner with someone like you. Can you explain how your platform really helps a lender improve their collections process and the rate of collection?
One obvious benefit is, with our platform, a fintech or any new age lender gets access to a pan-India collections network at no cost. And what I mean by that is that otherwise you would have to go and find these people and onboard them. But on my platform, you have hundreds of agencies already available, which offer you a pan-India presence. One of the major issues with collections in the past is complete lack of visibility of activities. So how a typical collections process would work is you would, in an Excel sheet, give cases to a collection agency, which would start doing calling activities, either using some dialer solution that they have, which is the extent of technology that any agency has. And then you as a lender would probably at a later date note how much money you receive, or what is on a portfolio level or a macro level, what has been done in your cases. There's no real-time visibility that you have on your portfolio. Similarly, most of these are completely non-compliant from a regulatory requirements in terms of data security, availability of real-time recordings. So if you look at what the platform does, and I'm going to get into maybe talking about the platform a little more to explain this, is that at one go you get real-time visibility of all activities that are going on your portfolio. You get a solution which is regulatory compliant, whatever the regulator requires. You of course get access to ML-based algorithms, which are not just looking at your data, but they're looking at millions of data points on similar customers that the system may have seen in the past and created propensity to pay modeling on, which for a new lender would take you a long time to develop. And even if you do develop your own internal collectability scores or propensity to pay scores, or do risk classification of customers from a collections perspective, those models would still be biased by the underwriting that you as a lender have done. What this platform allows us to do is actually look at cohorts across different lenders and across different types of underwriting to find what is the right methodology or strategy that we should deploy to collect from anyone that's in the collections queue.
Understood. And Aditya, normally when you talk about collection, people keep talking about technology, but I think a lot of time people tend to forget that for a country like India, there's so much physical reach and physical network which is required. And now I'm going to go through a few numbers, in fact, a lot of numbers. Tell us if we have got some of the numbers wrong, if they have got updated. But I see that you are across more than 20 Indian states, 3,100 plus telecollectors, 3,600 plus FOS collection agents, 250,000 plus cash drop points, and 1,500 plus cash pickup agents. Now, this building this physical network would not have been very easy. Can you talk us through some of the challenges that you faced and how did you circumvent those challenges while building such a network?
So you're right. I mean, it takes time to create this network, and one is finding these agencies itself, right? So what you have to do is talk to a lot of people who've possibly talked to banks and NBFCs who've been around for the longest time to figure out where these collection agencies are. Of course, you have to find on the cash drop points and on the cash pickup. You have to find aggregators like payment banks or logistics companies that offer services to e-commerce giants in the country, which would give you ready access to a large pool of such merchants who can act as cash drop points or agents who actually come to your house and work with logistic companies for large e-com firms. Some of the issues that we faced initially was that agencies would often look at us as competition that would take the business away, because when you first go to them, in a sense, it's for them it seems like while they could directly work with these lenders, here's someone who sits in the middle and therefore restricts access that they would typically have. So it wasn't very easy to explain to them that we would actually increase their business by getting vendors on the platform. So in a sense, while they remain the primary service providers offering the last mile collections effort, we were in a sense doing a lot of business development for them. Even initially and possibly even now to a certain extent, the scale of cases on the platform is also an issue. It's sort of like a supply and demand problem, because still you have a lot of service providers on your platform. Lenders do not want to come on board because you may not be able to service all the locations that they want. They're giving loans in. And on the other side, agencies, if you onboard them with not enough cases, they'd rather at the end of the month you realize that they've worked on the tens of thousands of cases that large banks have given them, and not the thousands that you have given them for the partners that you work with. So that took us a little bit of time. Of course, now with more than 500,000 odd cases on a monthly basis, we do sort of incentivize them to work with us. In some cases, we also actually in locations where fintechs have started to lend, but there's not enough agency presence because banks and larger NBFCs are traditionally not linked there. We do get agencies to work with us by doing some sort of retainer plus a success fee model, and that works because while we may not have enough cases by one lender, an expansion into a new geography, this route also then allows us to go to another lender and say we already have some sort of presence here. And this is especially in terms of in newer areas. So all lenders have lent in the top 20, 25 cities. Now that you see fintechs tying up with e-commerce people and actually giving loans on those sites, and a lot of these consumer durable loans, or as you saw during festivals on e-commerce sites, lending is now spread across the country, and some of the lenders we work with expect us to be wherever they're lending, giving loans out. So it's been a journey to that. Another issue that we faced initially was that agencies are very, very reluctant to embrace technology. They're used to working on Excels, they're used to taking printouts with them for field collections. So to evangelize the use of technology for them, telling them that there's no way that they can download data from the platform. We mask phone numbers, so there's no way that they can interact directly with the customer. There's no papers that they can carry on the field, but they can only use our web-based calling platform and our app for field collections. That also is a problem that we faced. The one last point is agent training, and that's a very, very important aspect because there's huge regulatory and reputational risk in any interaction that a collector has with a borrower. So, ensuring that proper due diligence is done on the agencies and agents, plus the training is done on the systems and code of conduct is a huge operational task.
Got it. And Aditya, you just also touched upon the role of data-driven decision making to optimize and improve the collection efficiency. Can you explain to us a bit how you're using data analytics and machine learning to improve the decision making and improve the collection efficiency on your platform?
There are two important questions to answer when you're looking at a portfolio of customers, right? One is who do I think has a higher propensity to pay, or who do I think is someone who will pay? And the next question is, how will this person pay? Right. So essentially, in a sense, we have these two models which we call Sherlock and Feluda. Sherlock was our first tool, which is essentially a prioritization algo that dynamically sorts the collections queue. So when I get a lot of cases into the platform, Sherlock takes a look at that data, looks at if you've seen similar customers and cohorts in the past, and gives a score to each customer to say what is the propensity to pay of this particular customer. Prioritizes them for agency. So it's not at the agency's discretion or the telecall or field collector's discretion to decide how they want to work on the cases that we've allocated to them. They have to follow this platform, which means that anyone I classify as now has a very, very high propensity to pay, and therefore to increase efficiency in the platform, attack these people first, or try to collect from these people first, and therefore leave the more difficult people towards the end. So the easier to collect from are the ones that you collect quickly from. And then this is a macro level view of who I can collect from. The micro level view would be, if I know that I can collect from someone, what is the right channel that I should be doing? So if Sherlock is a prioritization algorithm, then Feluda is a profiling algorithm that actually bases interactions across different communication channels, actually creates what is the right way to collect from this person, what is the right channel to be deployed. Is it digital? Is it telecalling? Is it field? What is the right time to interact with this customer? What's the right language? What are keywords that you should be using? What is the payment system that this customer would prefer to use? Is it going to be cash, or is this customer more online? And then we deploy Feluda to actually create active eligibility for each case. And based on eligibility, we push each customer into either a digital queue or a calling queue or a field queue. So these two algorithms essentially determine how and who we collect from, and what is the right methodology. In a sense, creating a customer level collection strategy. One of the things that collections typically has overlooked has been a one size fit all. Now, during underwriting, each customer is scored differently. But in collections, if the same brute force is used for everyone, that really is not the right strategy. This allows us to then create very bespoke, customized collection strategy and methodology for each person that flows into the queue.
Got it. Now, Aditya, that gives us a very good view into the capabilities and the services of the platform. Now, assume that if I am a new age fintech and I want to start working with you, can you tell us what the process would be? Is it completely digital? What parts of it are physical? And how soon can I get up and running if I decide to work with CreditMate for my collections business?
So it is completely digital, and how soon depends on legal contracting. that's the only bit that is offline, and that differs between different fintechs and larger NBFCs and banks. With banks, it takes much longer time for both legal as well as integrations. But with fintechs, that's of course a much reduced cycle. It's completely digital. We have API documentation that's available. The platform comes integrated with all digital gateways, which is SMS gateways, outbound dialing, WhatsApp, emails, cloud telephony service providers. It comes integrated with 5-6 different payment gateways. So basis APIs, we can go live in 1 or 2 days, depending on the bandwidth that the lender has. Extremely simple APIs. So essentially, we've gone live with lenders within 2 days.
That's pretty amazing to go live with someone in just 2 days, in fact. I had a follow-up question on that one. How would the pricing for these fintechs work? Do they only pay for the platform use, something like a SaaS model? Or are there other models that you also work on?
Yeah, so we have two different engagement models. One is of course SaaS, which means that the lender can take this platform and say, I'm going to manage all my collections through this platform. The other is like a collection services, where the lender actually allocates cases to us, and we act as an aggregator agency. We take the cases on the platform, and then we deploy our internal digital collections or digital resolutions team, and then our service providers in the calling and field space to actually work on the cases and resolve them for the lender. So in the collection services, I'm a single point of contact. It's almost like a collection agency that the lender is tying up with, and I deploy my technology to do all this work. In a SaaS platform, of course, the lender takes the platform, uses their own internal people on the platform, uses their other existing collection agencies, and possibly even me as one of the agencies on the platform.
Yeah, if I understood this correctly, in the second model that you pick up, right, this is essentially something that we're doing everything end to end.
Yes. So we're doing everything end to end, where you give cases to me, and essentially your role as a lender ends, and then I take it and work with my agencies to actually do the collections for you. Where, of course, the pricing is completely success based. Typically, how this works, and it's been extremely complicated pricing, and therefore reconciliation, invoicing is a huge headache in the collection space. We've done two interesting things with pricing. Essentially, tried to bifurcate the effort that's been put into us and the channel that's been used to collect, and price accordingly. That's something that we have used in the past. COVID times has been a little difficult to do this, and therefore it's standard pricing. But typically, because I have complete control of all activities and I can track down to an individual call, I know what is the effort and what's the queue that has led to resolution of a case. So we can actually charge differently basis. So digital led resolution can be charged lesser than a field led resolutions, which is something that was never there in the market. But typically, it remains success based on collection as a service. On the SaaS platform, it is a very small percentage of the collections that a lender does by using my platform. In a way, almost like a payment gateway charges you per transaction, we charge a very small fee on successful collections. What that means is you can upload all your cases. You can have as many people as you want working on the platform. I'm just going to charge you a small success fee on cases that you collect on, because you're using the ecosystem and the intelligence that I've created.
I think that's pretty interesting because this, I think, would be actually more efficient and cheaper than the traditional method of maybe tying up with multiple collection agencies, each with their own different pricing model.
Absolutely.
The other thing I'd like to check with you, Aditya, is maybe since we've talked a lot about the platform so far, it'll be good to just maybe summarize what might be the maybe top two or three differences between traditional players and platforms such as yours.
One huge difference, as I said, of course, is the intelligence that we deploy. Typically, when you work with any traditional player, they're not really providing those services. Most traditional players would only give you a calling facility or a field collections facility. There's no intelligence that they provide. You as a lender would probably have to give any intelligence to them to be able to do collections.
Yep.
Which is a huge benefit. Two, of course, is in terms of data security, which is a benefit, because typically, if you share data in Excel sheet, you do know that the data is being sold or shared, which is something that RBI does not allow.
Yep.
Another huge benefit is around transparency and visibility. As I said, it's typically collections has been a black hole where essentially all you manage to get is how much money you've recovered, and you lose all the data that you've collected in the collections process. There's a lot of new data that a lender can find in the collections process, be it new addresses, new phone numbers, just the conversation leading to why a customer has not been able to pay or is not paying, or there's the customer service issues, there are frauds that we have found. Some of that information just never flows back to a lender, and even if it does, it's updated in Excel sheet. It doesn't get ingested back into a lender's loan management systems. So this fully integrated platform gives them that benefit. And as I said, it's a full stack. From one platform itself, you're running digital calling and field. So like an omni-channel for collections. And all of these, because all of them can happen from only within the platform, I have logs of each and every event that I run on customers. So now we have millions and millions of data points, which allows me and therefore the lender to actually benefit from the heuristics and algos that we can run on those data.
Switching gears a bit, Aditya, in December 2019, you came out with a survey which was conducted among 2 lakh borrowers across 30 states and 40 lenders. And the survey highlighted that the delay in salary and business downturn were the main two reasons for defaults. Now, no one expected the year that we have had in 2020, and things have taken a turn for the worse. Now, looking at the data, what does that say about the year that we have had? What does the future hold for us?
So if you look at what's happened over the last 9 months, from our perspective also, while we started to see a slowing down in the economy, even the beginning of this year pre-COVID, Jan and Feb was still our best months, and we were able to recover. There was a definite drop from April onwards to around June, and then after that there's been a slow uptick. And current numbers, not just for us, but if you talk to any lender, any industry player in terms of collections, while not back to pre-COVID numbers, we're essentially close to pre-COVID numbers in terms of resolutions. not much has changed in terms of the reasons that people have for not paying, other than delay in salary has also now sort of changed to loss of salary. That's something that we've definitely seen. Business downturn is definitely one of the key reasons that we are seeing. Another thing that's happened, Hemant Roy, is while there are a lot of people who possibly do have a little bit of money in hand, sometimes they do say that they're saving it for a rainy day, and therefore we've seen a lot of requests for restructuring of loans coming in, where people say that while they do have the money to pay, is there a way to restructure where there could be delayed payments, or it could be spread out over a longer tenor, so on a monthly basis the outflow or the outgo is a little lesser. So that's something that we are seeing a lot of requests for restructuring of loans. We saw a lot of people asking for a moratorium, and even from our lenders, we saw that for some lenders, even 60 to 70% of their book went into moratorium. And only now are we starting to maybe see an effect of that coming in, because end of moratorium now, it's been 3 months, so some of those cases that are not started to pay will start to hit NPA pools. It's a gradual increase in resolution numbers, but we still do see stress both from salaried as well as self-employed people in the market.
And in fact, I think what I love about an entrepreneur is that even in the worst of the times and in the most difficult of the times, all of them, including us as well, we tend to be optimistic, right? We are always optimistic that things would improve, and the green shoots have started becoming visible. So hopefully we have a good time and good year ahead. Looking at that, and when looking at the future, from your point of view, what are the three major trends that you foresee that will shape our industry?
So, the collection space gets impacted essentially a lot by the lending space, right? So essentially, there are a lot of things that we're already seeing. And what I think the few things that will happen is one, focus on technology, not just on underwriting, but in the collection space also. Typically, the conversation has always been around growth in book and not on portfolio quality, which is something that's changed in the last 8-9 months. So that's a trend that I think will continue to be prevalent, where people will be talking of asset quality more than just a growth in book. We're also seeing a lot more investment being made in technology in collections. For a lot of people, that was an afterthought, where you could still manage to do collections on Excel sheet even when you had a decently large book. Or that is changing. I think lender systems, and this I'm talking about loan management systems itself, have started to undergo changes because there's a lot of restructuring that is happening. You would have to come out with novel ways and innovative ways to be able to restructure, and some of the lender systems are not available and not capable to do that. So we're also seeing a lot of lenders making investment on technology on that front. I think more and more service providers in the collection space will be expected to deploy more technology, to be able to service clients. I think the regulator is also going to be a little more strict on that. And one key thing is feedback from the collections ecosystem back to lenders. That's a leg that was often overlooked, but that's something that I think more and more lenders will need. Feedback from the market, and the last mile is these collection agencies or the digital players who are trying to solve this problem. I think feedback from them on market conditions, on requirements of borrowers, both existing as well as new borrowers. I think that is something that lenders will start to look at much more.
It's been great speaking with you, Aditya, and thanks for taking this time for sharing a whole wealth of information on the tricky area of collections with our listeners. For our fintech listeners, what's the best way to learn more about CreditMate and get in touch with you to see how collaboration with CreditMate is possible?
So, of course, they can go to our site, creditmate.in. They can reach out to me on Aditya at creditmate.in. And I'm happy to share my phone number, on the podcast if you guys allow that.
Thanks a ton, Aditya, for being on the show. And that's it for this week on India Fintech Diaries. Do pay a visit to our website, indiafintechdiaries.com, for exclusive content that ties into the episodes on the show. Wishing you all a very Merry Christmas, and do stay safe.